All right, everyone. Welcome back to another episode of Bell Curve. Before we jump in, quick disclaimer. The views expressed by my co-host today are their personal views, and they do not represent the views of any organization with which the co-hosts are associated with. Nothing in the episode is construed or relied upon as financial, technical, tax, legal, or other advice. You know the deal. Now, let's jump into the episode. Valora is the easiest way to send, swap, collect, and grow your crypto on the Valora blockchain. Download the app and start exploring dApps like Jump Task today at valoraapp.com/empire. Welcome back to another Roundup. You got Michael, and Vance. What's going on, guys?
Up.
Glad to be here.
I prefer
Michael's 1 and 2.
Michael's 1 and 2. Well, I wasn't sure if you're going by Mike these days. I didn't know if you ended up making a decision. I know you've been like debating.
Michael's kind of convinced me. I'm in a transition phase here. Yeah.
wow.
Michael and Michael.
Yeah.
Vance and Michael, I feel like we're supposed to give a disclosure now that you guys are now investors in Blockworks. How's it feel to be not just co-hosts, but co-owners of the Bell Curve podcast?
You check the contract. I don't know if we're actually co-owners of the podcast. It's good to be investors. And yeah, I mean, you guys are growing super quickly. You've got a good team. So it feels good. You know, we've looked at a lot of different startups, and you guys are definitely growing quickly, and it's impressive. So hats off to you.
Really excited to be a part of it.
How so professional of you.
Maybe a little bit more gusto next time.
Yeah, I really believed you there, Michael. Seriously.
Really fired up to be along for the ride.
Yeah. No,
Once you made the sale, stop selling.
how does it feel to have us as investors now?
We're really excited to have you about. That was all about. We're psyched.
Yeah, no, it's fun. Yeah, we're good. I did a lot of good. So, what are you guys paying attention to this week outside of our big announcement? What's interesting?
There's a lot of funny stuff that happened this week. The one that I don't think is on our prep doc was Aragon.
We were debating whether or not to get into that, but I saw you ripping some fun tweets about it. So can you maybe give us a lay of the land on what's happening in Aragon land?
Yeah, so Aragon is a project that has developed various different software products. Aragon Court being one of them. It's funny because it's like it's supposed to be a court for like DAO governance, which is like obviously sorely needed in the wake of this kind of blowing up. But they built a bunch of different things. They raised a bunch of ETH in an ICO in 2017, I guess it was, and they've kind of been this beleaguered project that just spends money on kind of this, that, and the other thing, like crazy offsites, stuff like that. Basically, there's a lot of allegations of like, you should just return this money to the community, and a few funds decided to try that tact over the past, I think, quarter. And so these funds bought a bunch of Aragon or accumulated a bunch of Aragon, and they pushed to a vote with the DAO, return the capital immediately. Let's kind of right the ship and go on our separate ways. And I think they did vote to and successfully pass this measure to return all the capital. And then right as it was about to happen, Aragon Foundation rugged the Aragon DAO, took all of the money, and called the process of voting a majority of votes and passing something a 51% attack on democracy. Just absolutely hilarious that they would call it that. Also, like, there is no 51% attack in something that isn't a base layer. Like, it's just like called voting. And I think a bunch of the funds that tried this got worked because like Aragon is now worth basically zero. If the treasury is also worth zero. And Aragon Foundation also just looks terrible for rugging all of these people. It's not really their money anyways. Like, it's supposed to be a DAO until they didn't want it to be. And yeah, just like the levels of like cope and saltiness on the timeline this week were unbelievable. It really felt like people probably maybe bought a little bit too much ANT and it just didn't work. And it's just a friendly reminder that like this is not TradFi. And also, like, don't try to real fair value raid a treasury that can unilaterally move the funds on you. Like, that feels like something that comes up in the first hour of diligence when you think about this project. But curious to hear what you guys think. Just is an overall shit show, in my opinion.
I'm not really sure if I have a super specialized take here. I did see, Arca, they proposed the buyback basically because the FDV of Aragon, I guess, is trading below the book value of the treasury. I guess I should have looked this up before I just went to, but I would guess most of that treasury is made up of the native token anyway. So I think it's probably, I don't know about that as an investment strategy frankly, for projects at this stage. But yeah, I think it's kind of unmasking some of the decentralization theater that happens, especially at early stage DAOs. And every time there's something like this that happens, it's not, like, strictly speaking, a massive deal, but I think it does sort of chip away at this idea of decentralization that crypto is supposed to be. So yeah, I just think it's kind of a black mark overall.
Yeah, and not necessarily saying that this is the case at all, but in this particular situation. But I do think that it does kind of like beg the question of what happens when a protocol is done and like it's built, it's complete, we're not going to be changing it anymore. Like, what do you do with the treasury that people are sitting on at that point? And I think ultimately what should happen is that it should be value that is delivered back to the community, back to the users of the protocol in some way, shape, or form. But yeah, I mean, in this case, obviously not happening. Also, like, I don't even know what Aragon is at this point. They have a massive treasury, but also not a ton of product. And so, yeah, I think this situation is very different, but being able to have like the protocol being finished and then being able to deliver that value back to users, I think is an important step in sufficient decentralization.
So let me just make sure I understand this correctly. So before this, the DAO funds, so basically the argument is that Aragon did a bad job of establishing value for the ANT token, which is their governance token. The ANT fell below the treasury value. Arca came in, bought a bunch of tokens, then wrapped the tokens in a very quick amount of time, gave them voting rights. They voted for pro rata distribution of the treasury back to token holders so that they could make some money. And then rather than doing that, like following the actual governance vote, Aragon said that they were getting 51% attacked and changed it so that DAO funds were no longer by the DAO, but now governed by a grants program.
That's right. Like at the time of the vote, I think Aragon was like 120 million and they had 200 million of non-stable or non-native network assets in the treasury. And so like there was this arb if you could get it all returned. But if you've ever done governance or ever spent time in any of these DAOs, it's very clear to you that there's kind of two phases of governance. One is snapshot. And snapshot's not connected to a smart contract. Snapshot's more of like a polling mechanism. And then you need someone with a multi-sig, or I guess in this case, someone who had unilateral control over all the assets to like go do something. So yeah, I mean, the corporate to be, just got hosed here. Like, but also like, should you have known that? Probably.
Yeah, well, I think you're trying to apply the activist investing model to crypto, right? Like, what's the activist model in a nutshell? And you take a company that has great products, a lot of use, like a lot of customers, huge TAM, passionate audience and community and like user base, usually cash flow positive, all good things, all green checks. The X would be misaligned management or misaligned employees.
Well,
like, that's what it seems like you have with it.
I'd actually say, activist investing, yes, for sure. This is more of like the classic Warren Buffett investing, where his classic line is like, I'm not trying to find solid companies that are trading at reasonable prices. Like, I'm trying to find like cigarette butts that people have already literally thrown to the gutter, but there's still like a couple of puffs left in them. Things that are trading below their residual value, things that are trading below their cash value. But the leap here is that you have the assumption that you're going to be able to take that purchase of these assets, the ANT token in this case, for 120 million in value, and be able to recover 200 million in value. And I think that's Vance's point, which I totally agree with. It's like anyone who's experienced in any of these decentralized governance mechanisms, you're not going to be able to just flip a switch and turn over like, all right, give me the money now. No, that's not how this works.
No, seeing Aragon Corp, like, you give the money? Still no. Like, this is just, these things are honeypots for TradFi people, I feel like. Because it looks and feels exactly like traditional finance. But it's not.
So what's happening with Aragon now? So now they took back control and they're fine?
I wouldn't say they're fine. I would say there's like pending lawsuits, but like it's a Swiss registered utility token. So like pack your bags, you're going to Switzerland.
Yeah.
And
Here's why this is going to be bad as well is you only get like, Mike and I have been talking about this a lot actually with Bitcoin, which is like now that Bitcoin's venturing into like DeFi on Bitcoin and things like that, it's actually hurting the brand, I think, because you kind of only get as a company like one, maybe two words to describe your brand. And you have to like rally a community around that, like that word and that ethos. And if Aragon isn't willing to operate as a real DAO here, their mission and like their values are completely killed, which kills like that is their customer set, you know?
Yeah. I would say they lost track of like who their customers were a long time ago. Like Aragon Court doesn't really work. Like Aragon, the DAO governance framework is like, okay, not great. How does it all connect to a token? Extremely unclear. Maybe some of these things shouldn't have a token, but you know, like
this is,
Yes. Yeah. It doesn't make sense.
This is a bummer to me because like, if Aragon didn't have a token, Aragon could have just been a sick SaaS company where they just built really good products and just charged people $20K a year, increased it as the seats went up, and boom, called it a.
I was just a note here. I was actually wrong. I just assumed most of their treasury would be in their native token, but they actually did a much better job than most DAOs in diversifying. So I would have loved if USDC and ETH were flipped here, but I mean, this is like a top 5% of DAO treasury management. Like what I know about.
Yep. These are ideas that come to people in bear markets when they're like, ooh, we should like go after this person and get their money because like they're not spending it wisely. And like it kind of never seems to work. I guess like Rook DAO kind of worked in this same vein. That was like the success case. But
why is that, Vance? Why is that wrong? The token market cap is 110 million and their treasury is 185 million. So if you're like, it's a huge mismatch there.
Sure, your upside is you make 1x. Your downside is you lose everything. 1x. Like there's no asymmetry there, and like chances are you're going to get rugged. And the amount of people that have like pitched like Tezos has fought, or like I think it's like $2 or $3 billion of their treasury now. Like let's go get them. It's like I'll see you when you get back. I'm just gonna like buy ETH and chill. Like it doesn't feel like that's the best use of your time. And there's like things that feel like work when you invest, like when you're like doing things, and then there's just like things that don't, where you're just like holding and being patient. It feels like people just wanted to do some work here, and it didn't really pan out.
Well, and it stems from the fact that you have all these activist investors in TradFi. You have the Warren Buffett investment standards in TradFi, and people want to replicate that and be those things in Web3. And because of that, it's sort of like this imposter syndrome of, oh, I want to be able to go off and like extract value from like 125 to 185. And it just doesn't work the same way. And so, yeah, I think, we've seen this a number of times. Like we know a number of investors who have the same mentality and have the same strategy. But frankly, I haven't seen a repeatable process that works.
By the way, did you see that Hindenburg's latest target is actually Carl Icahn? I don't know.
Oh yeah, crazy story. Like it doesn't look good for Carl.
I haven't looked at this. What's going on?
So there's basically allegations of him inflating asset values that are liquid, and there's pretty good evidence to suggest that that's probably happening. Carl owns 85% of the shares, and his son owns 85% of the shares of Carl Icahn company. I forget what it's called. Maybe it's just called
Icahn Enterprises.
Icahn Enterprises. And he's pledged 65% of the 85% as personal margin loans. Now, if I told you this story,
what does that remind you of?
Did I remove that? Marking up liquid assets, paying quarterly dividends that people have advised him to not do, allegedly colluding with Jefferies, which is an investment bank, to sell these shares to retail, and then taking out massive personal margin loans. Like, he's obviously like a legend, and I'm sure he would say terrible things about crypto if he had the chance. But like, what are you doing? What is the most plausible solution for this, or answer for all of these questions? And he hasn't put any answers to the questions that Hindenburg asked, and he's just continuing to increase his pledges of shares against these margin loans. And the things that he will not disclose are, what are the terms of the loans? What's the liquidation price? What's the loan to value? How much debt have you pulled out of this thing? And the other interesting part is, so he pays out this massive 2% dividend per quarter, but he doesn't pay it to himself. He takes his dividend in paid in kind shares.
Yeah, I saw that.
So like think of this as like, like if he were to take the dividend in cash, he would dilute everybody else's dividend. So he doesn't do that. Instead, what he does is he just takes more shares, pledges them as margin loans, and like it all works in this circular way.
Wax on, wax off.
Yeah, I'm sure there's no problem, but I just like, I don't know.
It makes me wonder how many times other people have run this same scheme. Because, right, if you're, obviously, people who listen to this podcast are familiar with the FTT scheme that he was pulling, and you could basically replace FTT with shares of Icon Enterprises and Jefferies with Genesis, and you'd be right there, right, with the exact same analogy. And I don't know, I didn't realize, I was like, when I've kind of put that together with what he was doing, with what SBF was doing, I was like, oh, that's actually, it's kind of clever, but maybe he was just running the playbook that millions of billionaires have run before. I don't know.
The answer is a lot. A lot of people have run this playbook before.
Cool.
Got to imagine Bill Ackman's pretty hyped right now.
Oh yeah, he was retweeting Hindenburg and all that stuff, and
he's sitting in his apartment like, let's fucking go.
Let's go.
Yeah,
I bet that guy's so fired up right now.
Oh,
one of the most epic moments of financial media ever was when Ackman went on CNBC, and then Icon joins the call, and they're duking it out on CNBC.
Is that over Herbalife or something?
Yeah, Herbalife.
Yeah.
Definitely.
Tore him apart. And then Bill Ackman made a documentary, still on Netflix.
Yeah, I remember that well.
Not all that good, honestly.
Yeah. You know what it just reminds me of?
And then he did a 2-hour pitch to investors about why it was a Ponzi or a pyramid scheme, and then he asked for questions. A bunch of questions went up, and he called on his dad first, who had placed a question in the audience.
Jesus.
I was like, oh, this is not
Anybody else want to call their dad?
Wow, you can't make this stuff up. You know what? Just don't want to detour too far from here, but Druckenmiller did a great speech this week. You can look it up, and he had this line. It's resonated with me, having been in crypto now for 5 years. But it's like, yeah, when there's zero interest rates, people just make really dumb decisions. When there are 0% interest rates for 11 years, people make really dumb decisions. And I don't know if it's Carl Icahn, but I do think everything that happened in crypto is probably a preview for the real show, which is going to be TradFi, and we'll figure out some people are definitely swimming naked.
I feel like we're further in the process of crypto kind of getting worked and then cleaning itself up. Like we're still kind of on cleanup duty for the past 2 years. Like we're distributing Celsius, Voyager, BlockFi, Genesis will get resolved one way or the other. This also feels like the bear market where everybody gets their coins back from Mt. Gox and the pro, or like gets their coin back, meaning like, the US government is selling it on Coinbase. But, I think there's a good deal of mopping up that we still have to do. I feel like the TradFi space is we haven't even had like the spillage yet. It's just like everything is so shaky and frenzied that if Icon is taking it in the teeth, like he's supposed to be, he's supposed to be the guy who's like responsible, basically. It's not the first one to get it.
TradFi has yet to hit their Luna moment. And the other thing that happened this week, last year, is Luna. Like it has officially been 12 months since everything started happening. And we're still here.
Day that it happened, Michael and I were at a wedding. I gave the best man speech, and then literally 2 hours later, we were like, "Ooh, it's all falling apart, isn't it?"
That was terrible.
That was nuts. Doe was this was around the same time as permissionless last year, and Doe was supposed to speak.
Yeah.
They actually sent down a whole bunch of swag, Terra swag. They had someone come by real quick and grab all of that, but not quick enough because I got a T-shirt. Yeah, pretty
Commemorative T-shirt.
Commemorative T-shirt. Yeah. I would love to get your guys' thoughts. Just moving it back to crypto here. There are a couple of big proposals that went live this week on Arbitrum and Uniswap. I'd love to start with the Arbitrum one. So this was proposed yesterday, so May 10th. But the proposal is the distribution of DAO revenue to ARB token holders. Just to read you kind of the high-level TLDR, the objective is to distribute a portion of the accumulated revenue from the Arbitrum DAO to ARB token holders. This will align community incentives and give ARB a purpose beyond a, quote, worthless governance token. Love that they included that there. As stated in recent tweets from Arbitrum, the DAO has accumulated roughly 3,352 ETH in revenue from L2 base and surplus fees. Distribution of revenue will be proportionate to the amount of ARB tokens delegated by each holder. So the benefits basically that they outline are distributing DAO revenue to ARB token holders will align community incentives and create a more engaged and committed user base, and it will give ARB this purpose. So I guess the disclosure that we have to caveat here is that Blockworks is a pretty big delegate for Arbitrum, so no opinions given here are indicative of anything. Yeah, caveat there. But framework guys, what do you guys, and what's your sort of take here?
Feels like the Overton window is moving for turning on fee switches or sharing fees generally, which I think is really positive. Like, I think if we get into the next bull run and we don't have real economics flowing, at least to the DAO, preferably like to the token itself, I think we're going to look pretty silly. Like, there has to be an end date in terms of when this happens. And I think it underscores just like what the temperature is of entrepreneurs in the US. Like, they're still willing to launch tokens. They're still willing to do things like turning on fee switches. And, maybe they feel like they're decentralized enough, or they feel like the protocol is finished and they can kind of call it just like this neutral, third-party layer. But I think it's positive in terms of like reading the room and understanding that the entrepreneurs that are still here are going to die on this hill, either in this country or a different one, and figure out how to make these protocols self-sustaining. And like, it's not, you have to squint to see it, but like at one point ETH was probably in like a similar position, like the transition of proof of work to proof of stake, giving back economics to the network. Like, eventually they were just decentralized enough to do it. And I think people are just saying like, why are we not as decentralized as they are? And maybe they aren't in practice, but like, they're starting to make arguments that put them in that window, which I think is important.
Yep. The only thing that I would add is that, in these sub markets where you have a number of different players that are going after the exact same models, the exact same, consumers, users of these protocols, imagine that you're one of those competitors and the other people are able to do this, whereas you are not. It's sort of like, imagine you're a centralized provider versus a decentralized opportunity where there's token incentives and there's token models that incentivize usage and incentivize people to come to your platform. It's sort of like, this is a level of competition that if you don't have it, you're not going to be able to compete. And you're just going to get, bulldozed by everybody else who's able to do this. So ultimately, I completely agree. I think a lot of what is going to change, the stuff that is going to change is like, we're going to have a model probably by the end of this year as to how this stuff can work. And there's a lot of movement on Capitol Hill right now to be able to have a framework to be able to build these things in this way in the U.S. and not under the ire of regulatory pressure. And so yeah, I think generally like this is going to be like the mainstay of what these future decentralized networks become.
I hear what you guys are saying. I think I've got a little pushback, which is, the way I sort of think about this is it's a capital allocation question. And for me, like usually when you talk about dividends or share buybacks or something like that, the implication is I don't have a better use for this capital. Like I couldn't put this to work in some way. which would lead to more value creation in the equity or the token of the project. So any sort of return to token holders, that just doesn't make sense to me at this stage. I guess that's an open question, Vance, to your point is, are these protocols done? But I have to imagine that's their job, right? If you're on the Arbitrum team, like, you're supposed to be allocating capital and creating value. That's going to lead to the appreciation of ARB, the token, which I feel like is that's got to be the most productive use of capital for a project at this stage. The other thing I would like, maybe like, this, the other way I kind of think about it is, once you start to return capital to token holders, you can't really stop, right? It's the same way that investors become super accustomed to a dividend. Like, there was a famous, like, it was GE, right? That was super famous for their dividend. It was like as good as gold. And yeah, it did really good stuff for GE stock. A lot of people bought it for that dividend. But later, once they had, problems, or there were better uses for that capital, maybe they didn't have the option to take it away, because so much of the holder base of that stock was conditioned to expect the dividend. That was the reason why they were holding it. So I think the race in between these L2s is wildly competitive. And if it were me, I would be trying to find uses for that capital instead of giving it away back to token holders at this stage.
Literally, Vance and I were having this conversation this week as to, like, what does value accrual look like for these tokens, and, like, how do you value these things going forward? I part of me agrees that, like, okay, yes, using all the different TradFi analogies, like dividends, share buybacks, whatever it is, you can look at them the same way. You can't take away a dividend because it looked negative. You can't,
right,
put the genie back in the bottle once it happens. The thing that I frankly just, like, don't necessarily think is congruent here is, I don't think any of these tokens are valued based on fundamentals. So when you're talking about, like, okay, is the profit accruing to the treasury, and, like, are we valuing this thing on, like, price to sales or price to earnings, or is the share buyback that's driving? I think all of this stuff is valued based on flows, which is, who is buying, who is selling. And if you can inject yourself into the flows question, there's actually a huge amount of, undetermined value that you can drive for the token itself, because it's not like if Maker was to go off and, like, double their revenue and therefore double the share buyback and burn, that they would be valued twice as much on a token value perspective. Maybe some people would look at it and they'd be able to say, okay, well, yeah, like, we can assume this and that, but it really comes down to, what are the flows of the token itself? What's supply and demand, and who is buying and who is selling? So I generally think, like, if you have a bunch of cash flow that's flowing to the token, having a token economic model that enables additional buying or additional, purchasing of the token itself from the treasury, and maybe it's redistribution of that token to the shareholders, or maybe it's redistribution of the token to the people that are staking it, whatever those models might be, like, that becomes super valuable. But we really have yet to see that, because right now the only asset that is earning this much revenue is ETH, and they burn part of the fees, but nobody else has hit that scale.
So I hear you on that. But I think, okay, a P&L might not be appropriate for something like that. And yeah, these things aren't trading based on price to sales or price to earnings or any other metric like that. But my counter to you would be, neither is basically any other early stage startup, right? Like an early stage SaaS company, investors aren't necessarily underwriting that based on their P&L or cash flow, right? There are certain metrics that you would look at, right? It would be like CAC and LTV and churn and growth rate and all that sort of stuff. Like, that goes into the valuation. I feel like we might just be at too early of a stage of crypto where those, like, what determines flows? What is the leading indicator for flows?
I actually disagree. I mean, as soon as you move past the Series A, people are valuing this thing based off of, what is your price to revenue? What is your, potential for profit? Like, you assume all these things. You don't ask those questions because they don't have any earnings. They don't have any, like, major EBITDA revenue multiples, whatever it is. Like, that stuff doesn't exist for a Series B company, but it should, because that's what people are valuing.
But then, Michael, wouldn't you assume then that, like, crypto has probably just been it's been in the seed and the Series A phase, and, like, there's a decent likelihood that in the next cycle, as more professional investors continue coming into crypto, they will start to look at Arbitrum and not just look at the flows, but they'll look at Arbitrum and say, okay, you're doing about 100 million in annualized revenue. You've got like 30 to 40% margins after the, the call data costs. After, 4844, you're going to probably go up to like 90% margins. Okay, like that's a pretty exciting business here. And you start valuing things on that.
You would assume that, but these are like the most inefficient markets that we've ever seen. And they're going to get more efficient over time. But I don't think people are going to start valuing these things. Like, think of all the infrastructure, the financial infrastructure that exists around like even startups, but also just like publicly traded stocks. We're not valuing these things and like trading these things based off of those fundamentals.
I have a slightly different perspective. I think like we've gone from like no valuation framework to like there was one that was like TVL divided by market cap that was just like insane and like meant nothing. And now like you're more in like the price to sales land. But like what the gross margins are, how much goes to the DAO, is the fee switch even turned on? Like people don't seem to be thinking about that. But I think like we're trending towards like a more efficient marketplace. And I think the real point is like once you have flows that confirm, these metrics, like you're going to have more of a rational valuation framework. Like imagine if Uniswap was buying back the token. Imagine if, any of the like Maker does it right now and it trades, at a pretty tight range of like 20 to 30 price to earnings. I think we're generally going to get there. And I think you also need to like potentially come up with a new valuation framework. And we've taken a couple shots at that, but I think mostly what you need is like, you usually have people who are passive buyers of stocks or commodities or bonds that are trading things based on, if it gets this cheap or this expensive, I'm going to do this or that. You don't really have that in crypto. Having the structural flow, I think, is kind of something that you're going to need to have if you're a serious project, coming into the next run. That's at least my thoughts.
Yep, I agree with that. I think a lot of it has to do with the investor base. And, in TradFi markets, they do have these like ranges that they look for PE multiples and that kind of thing. And if it goes below a certain multiple or something, a bunch more people will buy kind of thing. I don't think crypto is still mostly retail. I just don't think people are thinking like that. So
I mean, not only just like ranges, they have indexes where like if you're a part of this or a part of that, or like you hit this threshold, literally the index will have to buy you.
Yeah,
like that type of stuff. That's what I mean by the infrastructure just doesn't exist right now. So like we don't even know like how many retail investors in a given token like have ever been to tokenterminal.com or like DeFi Llama to actually understand like what these metrics are. Probably like 15%.
Yeah.
Or Blockworks users. Yeah.
Friend.
Enter in and say here. But like what is that percentage? It's probably less than 50.
It's definitely less. It's probably less than like 0.5. Yeah.
Exactly.
Yeah, I think so too.
Valora is the ultimate wallet for exploring the Celo ecosystem. Easily access over 50 crypto assets and 30 dApps for swapping, sending, and growing your crypto, all from your mobile phone. If you want to see real-world use cases for crypto, Valora's dApps page is the easiest way to access a growing list of the latest DeFi and refi applications. dApps like JumpTask come to mind. JumpTask is a Web3 gig marketplace that connects over 2 million micro freelancers to worldwide earning opportunities. With JumpTask, you can earn crypto by completing tasks, answering surveys, or even sharing internet. Then simply withdraw to your Valora wallet to send, swap, collect, and grow your portfolio. Download the app and start exploring today at valoraapp.com/empire. That's valoraapp.com/empire. Let's talk about Uniswap's fee switch. I mean, how do you guys, so this week GFX proposed turning on the fee switch. I don't know if you guys took a look at it. I can give an overview, but yeah, how do you guys feel about that one?
$60 million in 6-month revenue, like probably a little bit more than that in a bull market. Like this is something that, when things really get going is probably generating like mid 9 figures of revenue. That's like pretty impressive in terms of, like you're not investing in a startup for like what are they making today. It's like kind of where things are going to go. And it feels like that's kind of like really the bar for success for these dApps going forward is like, can you generate 9 figures of revenue per year, like mid 9 figures? And I think there's like a few that can get there. Uniswap's certainly one of them. I guess my question on this is like, what's going on in the background with the DAO? Like we've heard, different things about like different jurisdictions that you can do this in, and maybe it's more favorable. Like, is this the foundation that's leading it? Like that's definitely a question. The other thing that stood out is just like how reasonable their fees are compared to Coinbase and I guess less so Binance.
Oh yeah.
It's like pretty cheap, and the maker fees are negative, and the taker fees are less than the centralized exchanges. It's not surprising that they're doing more volume in these places. The Uniswap is doing more volume than Coinbase on a frequent basis. Like it just appears to have significant product market fit.
Vance, could you explain how these maker fees are negative?
So I mean, they're just incentivizing people to effectively add liquidity to the pool. And the taker, like, this may not mean a ton, but so if you are taking a limit order on centralized exchanges, you're usually given, or if you make a limit order, you're usually given a little bit less of a fee than you would if you just sold it all at market. And this is kind of like that idea taken to extreme, where like, like you're charged negative fees on making limit orders, but if you're just taking random liquidity, like it's going to cost you. Which is probably the right model. Like just looking at Coinbase's fees, they just seem, like what is it? Like if you scroll up a little bit, 40 basis points for things under $10,000, like and 60 basis points if you're the maker. Like that's pretty crazy. Uniswap has the inverse fee structure of that, where the makers are negative and the takers are significantly lower.
But that's sort of a misnomer, right? Because like, who is a maker on Uniswap? It's a liquidity provider. Yeah. And the one thing about, providing liquidity on Uniswap is you also are affected by impermanent loss. So like, while I understand like they want to represent these things as negative, I'm not sure that that's like a fair representation.
Yeah, like we don't provide liquidity in Uni v3 for a reason. Like we found that it's very easy to get picked off. It's very hard to provide liquidity profitably. And so I think the real litmus test at the end of the day is like, what do the LPs think? And there's a lot of stale liquidity. They're in these things, kind of like uninformed retail just getting hit. So I think over the long term, it's not about like, what are these fees for, the people who are swapping? It's like, are your liquidity providers making money after impermanent loss? And like we've had multiple portfolio companies try to build options vaults, derivatives, things like that. A lot of the impediment to them doing it is the Uni v3 architecture with regards to, you as a liquidity provider.
Yeah. Well, I think it's a super interesting point, and I think it connects with whenever we were talking about blend, this kind of key assumption. Like, look, they spell this right out here. The LPs making the most money off Uniswap are not retail traders. They're professional market makers, just like the ones seen on traditional exchanges. So I kind of do think you're seeing the evolution in just market structure for some of these DEXs. And basically, they're very comfortable assuming that the people that are the entities that will be providing liquidity into the future are not retail. It's not retail. It's professional hedge funds and market makers. And I broadly think that's the right assumption. I'm super interested. I'm kind of borrowing actually from a framework that Miles from who's been on the show at Reverie has. But like if you think about this, most of these protocols is kind of two-sided marketplaces. Pretty interesting indicator to pay attention to is the amount of pricing power that these protocols have over their supply side. In this case, it'll just be super interesting to see, basically how the LPs interact, and if it migrates somewhere else, like Curve or something like that. Like, to use the analogy of something like Airbnb, which is also a two-sided marketplace where demand is users and the supply side is homes. If Airbnb jacks their fees up, or like how many people stop supplying their home for people to stay in. And if they jack their fees up and nobody stops supplying their homes, then Airbnb's got a pretty good business. But if they like move their fee at all and they lose a whole bunch of their supply, then, that's something that you'd want to pay attention to. So Uniswap's been talking about this fee switch for a while, and this proposal gets into some of the technical. It's not a technically easy thing to do, actually. Especially for V3, it's kind of tough, and they're just FYI, they're testing it out on Polygon. first as well, V3 on Polygon, which I think is smart because the stakes are just a little lower. There's lower TVL and volume up there. So I just kind of want to see what happens at this point, you know? I just want to see what happens. Do you think a bunch of liquidity will migrate off of Uniswap?
At some point, yeah. Or like, it won't be the source of retail flow. That would be another option. I think like where Uniswap does really well are like long tail Pepe style coins. Where Uniswap doesn't do as well are like the blue chip, flow that, and frankly, like that's where their fees are generally the highest as well.
Yeah.
So I don't know. The landscape's just going to change with regards to liquidity venues over the next few years. And I think the first step is getting the money into the DAO. The second step is getting the money to the tokens. And like really the thing that Uniswap does not have is like a really strong community that can help them reason through all these issues. And it feels like that's going to be just like super important at some point, but probably not immediately.
I agree with that. Actually, do you want to talk about, there was some, or does anyone else have any more comments on the fee switch for Uniswap?
No.
This is also just because I know there's been a whole bunch of different proposals for this over the years, and sometimes it seems like they're picking up steam and then they kind of end up dying. But GFX Labs, like Getty Hill, they're like pretty serious people and deeply in the weeds on Uniswap. I feel like this feels like it actually might have some legs. I know we've seen it before, but I'll be very curious to see, how this plays out over the coming weeks and months.
What's quorum on a vote like this? Like, what does it take?
Yeah, that's a good question. I'm not actually sure.
I don't know.
No idea.
Usually it's like 5, or like in some DAOs we're involved in, it's like 0.5%. I would imagine something like this is probably like more of like 5%. But
yeah.
You're going to need a lot of tokens to get this through. It's just
yeah. There are lots of complications as well. So one of the big hurdles that has made this not get over the finish line is just tax and legal concerns. And GFX basically has this disclaimer where, look, this is kind of a treasury issue. I'm paraphrasing here, so they don't have a great solution for that. But yeah, I mean, I have no idea how that would work from a tax standpoint. If the DAO itself starts accruing revenue, I mean, what's the legal entity that ends up paying the tax? Is that road go down?
This is the tricky part. Like, if you can do it at all, it's best to not have it go to a DAO. You should just have it go straight to the tokens. Because, like, people who get the money, like, you should figure that out. Or do, like, a buy and burn where there is no revenue accruing. It's just, like, buy pressure and then deletion of supply. But, these are complex questions and nobody has answers for them.
Well, I think it's also exceedingly difficult when you're a U.S. company based in the United States with U.S. persons, and that is the DAO that you're going forward with. That being said, I think that, and who knows exactly what's going to come out, but talked about it a couple of weeks ago. It seems like there's going to be some proposal that goes forward in the next couple of months for things like how a security can become a commodity, what actually means decentralized or sufficiently decentralized. Like there will be a lot of answers to these questions in the United States, it seems, and we'll see whether or not that House proposal goes through and gets ratified by the Senate or voted on by the Senate. But I do think that it's also one hand, if not both hands, tied behind your back while you're trying to operate from the U.S.
What about on the regulatory side with like how you guys treat governance tokens? If you owned Uniswap tokens, I don't know if you do or don't, but like if you owned Uniswap tokens and this went forward, would you feel comfortable voting on this in today's regulatory world, or would you just you wouldn't touch that?
What we do with governance is we have a program where we delegate to a number of different entities and have them, vote on our behalf. That's how we, operate within governance.
And do you trust them to vote on your behalf, or do you tell them how you want?
We do not tell them anything. Usually, most of these entities are like blockchain clubs at universities. and they can vote on, however they see fit.
Vance didn't like that question so much that he muted and turned off his camera. I haven't seen that one in a while. This is a good time for me to call out that we are hiring a podcast producer on the crypto side. So if you are, yeah, Garrett was like, do not forget. I totally forgot to call that out. So we're hiring a new podcast producer. If you have a very deep understanding of crypto, DeFi, NFTs, all that kind of fun stuff, come join us. You are not the one editing the shows on the video and audio side. You are the one kind of like overseeing a show. So you'll like help us source and schedule guests. You plan and research episodes. You'll lay up some good content so that Michael can know what to say. Because tough to get this stuff off the noggin. You craft the content, post-production, all that kind of fun stuff. So if that's you, slide through the DMs. Actually, don't do that. Go on our careers page and apply.
Let's talk about everyone's favorite MEV bot, Jared from Subway. This is a great thread. I just thought it was a cool, I'm not sure if folks actually saw this thread, but Robert Miller kind of shed some light on the alpha. So I'll just share my screen here and walk people through it. But I think it's just kind of a cool case study of how these MEV bots actually work in practice. So basically, Jared, he's sort of famous, or this bot is sort of famous for making a whole bunch of money sandwiching traders on Pepe, the meme coin. And basically, the 3 bits of alpha that Robert walked us through was the way they do their inventory is very different from other bots. So if you think about a sandwich, depending on there are 2 assets that are required for a sandwich, and it kind of requires that you start in one asset. So ETH is sort of the front run, then you move into the meme coin Pepe, and then you back run back into ETH. But Jared actually takes a very different approach and starts with, he's got a whole bunch of supply of Pepe, the token, and then he goes back into ETH and then back into Pepe, and there's just much less competition. The reason why more bots don't do that is just because warehousing becomes very difficult. If you think of your balance sheet there, you don't really want to hold a whole bunch of your assets in something that's as volatile as something like Pepe, because any profits that you get from the sandwiching could be offset by declines from the meme coin basically failing. But I guess Jared from Subway is extremely good at sniping. And he actually bought the coin Pepe just 10 minutes after it was deployed. Just a little tinfoil hattie right there. But that's how he gets his warehouse or his inventory. And then he kind of does this interesting strategy of mega sandwiching. So he basically puts more trades into the sandwich than just a 1-1-1. So it's kind of an interest. I don't know if you guys had any takeaways, but I thought it was just a cool sort of inside look at how some of these MEV bots work.
I mean, it feels like we saw Jane Street stop doing MEV trading, I think like 2 or 3 weeks ago. And like these strategies feel very much in the gray area of like, is this profitable trading or is this something else? Kind of like Avi Eisenberg style. Yeah, I mean, it's not surprising to see like the big guys pull out of this specifically, and like these like Jared from Subway style characters start to emerge. But I think it just kind of is proof positive that at a certain level of economic activity, you see the MEV turn on, and then the MEV is a substantial portion of fees. Like I forget how much he spent in the few days where he was really going for it, but it was a substantial part of the MEV burn that happened via 1559. But I don't know. These are all good signs. Like MEV's turning back on. These crazy coins are turning back on. Pretty easy as an ETH validator to just sit there and collect your winnings.
Yeah, that's what I was going to say. It's just that maybe less the MEV side, but just the level of activity and engagement on Pepe itself just makes me feel like we're starting to see the green shoots of what this bear market is and moving past it. And, MEV is going to be a benefactor for all of that. So, and to Vance's point, I think it's very difficult to be doing that as an institution and necessarily from the United States. So you're going to start to see more Jareds from Subways, less Jane Street.
I think it's a tough, the builder market in general is one that's sort of opaque, and rule of law, up till this point hasn't necessarily been applied to MEV. The regulators there's some evidence that they're kind of aware of it, but they're not paying a lot of attention now. There was a great thread from this account, AI something. I'll get the name, but basically questioning whether or not, if you were a builder that had access to essentially order flow and you were trading using that information, does that constitute material non-public information, MNPI, and then is it insider trading? And you could certainly make a case for it. And my guess for something like Jane Street, and if you you can check Relay Scan, they have one of the most active and successful builders, but they haven't won like anything in the past week. And I would guess some compliance or legal or someone over there has said, hey guys, we could be at risk here. It's probably not worth it. I doubt they pull out of the builder market in general, but they probably have to retool some of their strategies.
I the other thing I would say is like, this stuff is like water. If you block one of it, like one direction of it, it's just going to flow somewhere else.
Yeah.
And it's not like, the people that are, searching are just going to like, oh, that's it. We're game up. We're moving on. And nobody else is going to pick up where they left off and continue forward. Like someone will. The value will be there. It'll just have to, be somewhere that is a more friendly jurisdiction.
The e-scaling roadmap, maybe smarter people than me could push back on this idea, but I think sort of implicitly requires the presence of larger, more sophisticated builders. I think Schwab is trying to get ahead of this with their ability to decentralize block building to some extent. But even a sequencer right now is the combination of it's a combined builder and proposer is what we've separated on ETH main chain. But especially as you have a proliferation of different L2s, and then eventually you get, maybe it's decentralized sequencers, maybe it's shared sequencers. They're still just dumb pipes that do the sequencing. You need a builder that understands state to stand in front of that. And builders, the more order flow that you see, the more transactions that you have access to, the better you'll be at winning blocks. So it's going to happen in Cosmos. I think it's going to happen in ETH L2s as well. Like, you're going to have big builders. So I doubt Jane Street is going to pull out permanently. I think they're just going to reassess.
Well, I saw some really silly liquidity chart, which was fake, by the way. I don't know if I saw a bunch of people retweeting it. I was like, mathematically, there's no way that this is possible. But some guy made this chart where it was there used to be 30,000 BTC liquidity within plus or minus 2%. And now it's one Bitcoin. It's okay, well, is that true? I don't have to do the math to know that that's unrealistic. But it just spread like wildfire. And then the last day of comments, all I heard on Twitter was low liquidity, watch out there. Could get crazy. All of my idiots, just think for yourself. These people are not pulling out, and if they do, there's going to be crypto native market makers to step in, which frankly I would rather have. I would rather have big crypto native market makers develop themselves than anything else. That's kind of the thing I'm still looking for is back in the day you had Alameda squaring off with 3AC squaring off with all the other crypto native market makers. It doesn't feel like there's those big people that are kind of just going for it. I think getting the big TradFi market makers out probably paves some room for them to develop.
I was about to say, I think there's a huge market opportunity right now to be that crypto native market maker that doesn't exist in the same way that Alameda 3AC used to exist.
Maybe not Alameda, but
I'm not talking about committing fraud. I'm just talking about making markets.
I mean, it's literally just Wintermute at this point.
Yeah. If you want to nerd out, there are different. There are some upstart market makers out there. I don't know how public they are, but there are different models for market making. It's my understanding is you kind of either market make on Bitcoin and ETH, and that's a much more traditional model, or you kind of have this token call option model of market making where you're given some percentage of Arbitrum per se, and you want to make a market on that at a certain price, and your allocation kind of ends up being something like that.
But isn't that a model that eventually goes away? That's kind of an early.
Yes, I think so too.
Yeah. That's not a real scalable.
No, I agree with that. Yeah.
Should we wrap?
Yeah, I think we got to wrap. All right, guys.